Happy Sunday. Happy Super Bowl Sunday. Today is February 11, 2024. Sunday morning for some people, Sunday afternoon for others. Some parts of the world, it's Monday. But anyway, it's February 11th. The Super Bowl has not happened yet at the time of making this video, that's for sure. It will kick off in about 6, 7 hours. So this is Rob Sin at CEO Technician on X, Goldfinger on CEO.ca, at Goldfinger Capital on YouTube. We're focusing on metals, China, and the gold miners in this video, really narrowing the focus because I don't want to make another hour-long video. This one's probably going to be more than 30 minutes by itself, just focused on these topics. So let's talk Turkey. Let's get right to it. We'll start with the metals charts: gold, silver, copper, and palladium. Kind of an obscure one, but I think it's worth looking at this week. And then we'll get into gold miners. Dreadful performance year to date. We're going to get a lot of earnings reports from the gold producers over the next 2 weeks, so we'll dig into that. And we'll talk about what the market is expecting and drill down on one gold producer in particular. So let's start with the chart of gold itself. So what is going on with gold? Really not a whole lot is going on with gold, but a couple of observations on the chart. Since the December blow off Sunday night short squeeze of 2152, gold has been doing what I call coiling. So coiling is when the range narrows and we get a lower high or lower highs and higher lows. So I could draw some lines here and you could see a bit of a triangle forming, but this is a coil. And I actually posted a chart on X, but I'm just going to do it, without drawing lines here. Let's just keep it as simple as possible. Gold is still in a uptrend since early October, but the range is narrowing. So volatility is compressing. The range that gold is trading in is getting smaller. Gold options, so the GLD implied volatility through the options for the GLD exchange traded fund, are very low. So the market is not pricing in a very big move in gold for the next 30 days. Part of that could have to do with the next Fed meeting. The next Fed meeting is in the second half of March. So it's more than 30 days away from today. That could be part of why the market is not thinking gold is going to make a big move up or down. But the fact is, big dips have been bought, rallies have been sold, price is focusing somewhere around 2030, 2040 an ounce. We spent a lot of time trading in the 2040s and 2050s last week. There was one push up above 2060 on Wednesday that failed, and gold closed the week towards the lower end of its range for the week. Okay, so I see support around 2030, then 2005, which kind of matches with the January lows, and then 1980 is a really big level. I know 2000 is that round number level, but it's not really a key technical level. On the upside, 2100, which is a round number, is actually a key technical level because gold has not closed above 2100 ever. So we had that spike high, but it was just for an hour on a Sunday night. Gold has not really spent any time above 2100. So that is still the big level. So big downside level 1980, big upside level 2100. We're sort of just smack dab in the middle of the range. So gold is range bound. There's really nothing more to say about it than that. Silver. Silver is weaker than gold. Silver is down significantly so far in 2024. Gold is down marginally. Okay. But silver has big support around 22 to 22.50 an ounce. So it's sitting just above big support. Okay, you can see that. You can see the moving averages have coupled up near 23.50, 50 days starting to slope down. So a downtrend has clearly taken shape the last couple of months in silver. Gold, it's more of an oscillation in a narrowing sideways range. So silver looks considerably different than gold does. Also, the relative strength in silver is in bearish territory, right? It's under 50 and it's trending lower. Gold is right at 50, 49.31 on the daily. So it's interesting that the GLD options are not pricing in a big move in gold. I would actually bet that gold, let's say in the next 30 days, will make a $50 plus move, either up or down. Maybe CPI on Tuesday is a catalyst. Maybe there's something else coming down the pipe, including another monthly jobs report the first week of March. But it seems to me when gold gets quiet like this and everybody thinks that it's not going anywhere, that's the time to bet that it will. Copper, another tweet I posted yesterday showing this head and shoulders pattern. So copper had a nice upside move at the end of January, got all the way back to 395, and it failed miserably, literally straight down since the end of January. 395 down to almost 365, closing last week at 368 a pound. But some people will argue about if this is a valid head and shoulders or not. It doesn't really matter, but it's pretty clear that there was support around 374, 375, and that support has snapped now. Next support, about 354, 355, somewhere back here in the October low range. So we're not there yet. And the main thing I have to say about copper is that this is showing that the manufacturing economy globally is not very strong. And the number one culprit is definitely what's happening in China. So construction slowing sharply in China. They're just not building as much because they've already built too much. They have a property bubble that is bursting or that has burst. So China is a real big question mark for copper and for a lot of other things. And this vertical drop that we've seen in the last 10 days is a sign that there's some real problems out there in China. We can say all we want about the supply deficits in the future, but right now, if the demand is just not there, then price is going to fall until buyers step up and scoop it up in size and put it in their inventories, right? So that does not appear to be happening yet in copper. Now, the sentiment on gold, silver, copper, all the sentiment on these three metals, the sentiment is in the middle of the range in all three of them. There's nothing to really make note of about investor sentiment on gold, silver, and copper right now. Okay, it's not at capitulation levels, even with silver in a downtrend the last couple of weeks. Investors aren't super bearish yet. Even with copper, getting clobbered last week, investors are not super bearish yet, right? So there's really nothing to make note of there in those three metals. But in palladium, you have extreme bearish sentiment. So the only futures market of all the futures markets out there, the only one with extreme bearish sentiment is palladium, with a daily sentiment index of 9. So when the daily sentiment index gets above 90 or gets under 10, when it gets into single digits, it's at an extreme, and it usually marks an important turning point within a few days. It doesn't have to be exact to the day. It usually doesn't happen like that, but within, let's say, 4 or 5 days, you usually get a bottom a tradable bounce in that market. The same thing happens to the upside. When a market rallies big, investors get euphoric, the DSI goes up to 93, 94, you can pretty much bet that you're about to see a turn lower in that given market. So Palladium is just hammered. The electric vehicle production is just not there. Clearly weak globally. EVs are eating some of their lunch, and there's substitution that's taken place. So for a long time, for many years, Palladium was trading 1,800, 2,000, 2,200, and platinum was only $1,000 an ounce. So everybody substituted back to platinum. All the auto manufacturers substituted away from palladium back towards platinum. And now both metals are basically the same price, about $870 an ounce. Palladium's actually a little bit lower today. So forget about, I'm not going to even try to analyze the palladium market and the drivers of it. I'm just going to look at the washed out sentiment, and then I'm going to zoom this chart back quite a bit. Let's look at a monthly chart. Let's even zoom it back. Let's go 15 years. Boom. Look to the left. Former resistance from 2011, 2014, support in 2018. Let's just draw the line. Let's make a little box here. Let's make it nice and pretty. Boom. Support. So Palladium is oversold on multiple time frames. It's been obliterated the last 3 years. It went from over 3,000 an ounce to 869 today. Sentiment. This is the most washed out, extreme negative sentiment of any market on the planet today. Palladium. Buy and close your eyes. If you're a physical, metal investor, this is a tremendous opportunity in palladium to try to get some metal at washed out levels with everybody negative on it and just stock it away. I've known guys in the last 20 years who have made tremendous trades on palladium, platinum, and rhodium. And there's no magic to it. They just have the stomach and the cash to buy at extremes, to buy a physical at extremes, and even be able to buy it at spot prices. So, they have contacts where they're able to get a hold of physical at or close to spot at major lows, just because people need cash and they have to sell. And then they wait a couple years, and it works like a charm. I recall this in 2008, 2009. I had a friend who bought palladium at 200 an ounce, sold it for over 1,000. Okay. Rhodium, bought it at like 750 or something, sold it above 4,000. Platinum is a little less volatile, but still, it can still work nicely. But palladium, in my mind, is a buy here. It's hard to put a stop loss on. If you're trading futures, you have to have a stop loss, but 800 is obviously a big round number level. That's a big support level. But this is a market that is just absolutely washed out. And, what could be a catalyst for palladium and platinum? Well, the platinum group metals just washed out. Palladium, platinum, and nickel, the production of these metals is going to be dropping globally. There's going to be mines taken offline. We're already seeing it in Australia. Talk of even some mines being shut down in Africa. Remember, South Africa is a big player in the PGM market. They have power outages on a regular basis. They have civil unrest, very unstable place. And a lot of these mines they're going way deep into the earth. There's definitely a supply risk where you could have a lot of supply come offline to help rebalance these markets. This is a big PGM producer. They've diversified a bit in recent years, more towards gold, but you can still see, ugly ugly, ugly, ugly chart here. Yeah, I mean, I've got nothing to say about this one, but if one of these big miners goes bankrupt, has to shutter a bunch of mines, that's a big upside potential catalyst for palladium and even for platinum or nickel, because often they're mined in the same, or they're found in the same ore bodies, right? Um, so palladium, sort of that contrarian play here, where the sentiment is just so dreadful. So let's turn to gold miners. So what is going on with the gold miners in 2024? Things seem to be going well in the final weeks of 2023. We had a nice rally there in November, going all the way up to Christmas. And then the new year started, and it's just been a massacre. Agnico minus 15%, Barrick minus 19%, Newmont minus more than 20%, Kinross minus 15%. So I just chose four of the bigger ones, and their performance is absolutely dreadful. I mean, it's literally like the worst performing sector of the entire stock market year to date. I mean, yes, it's early in the year, but what's going on here? And we saw the gold chart. Gold chart's just marking time going sideways. So there's a few choices here. I'm going to try to drill down on it and understand it. One choice is the market investors are betting that gold is about to drop back, I don't know, under 1900, back to 1800 or something. And they're pricing it in. They're getting out of the miners. Okay, that's one option. Second option is investors have lost all confidence in these companies' ability to contain costs and actually generate a profit margin, an operating margin. Okay, I think that's number two, and that's the most likely one. And then number three is just, China has been a disaster. And China, the strength of their economy, the strength of their markets has a strong correlation with the mining sector, whether it's copper mining or tin mining or gold mining. Just simply put, there's a strong correlation there. So the fact that China has had such a bad last year has weighed on mining companies, even gold miners that don't have operations in China. So those are the three main things that I see, main drivers of this weakness. But really, I think the second one is the biggest one, and that is that these companies just have a trend now, quarter after quarter, of disappointing the market, disappointing their investors, and not being able to contain costs. And have production shortfalls. So it's like a triple whammy here. China's a mess. Companies aren't producing as much gold and silver as they guided to, as they forecast, and their costs continue to tick up quarter after quarter, right? So in the next, and I just want to show you, so these are some miners. I think this is Barrick. I took these snapshots and I didn't leave the stock symbol on, but I think by memory, this is Barrick. Here's your gross margin since 2021, strong downtrend. Your net margin, very strong downtrend. Notice it's negative, right? They're not making money. So one of them is Newmont, one of them is Barrick, and one of them is Agnico. Or maybe I just posted two. Okay. So, yeah. I mean, just the net margin and the operating margin. So this is obviously Barrick, and this, is Agnico. So you can see the operating margin for AEM is still positive. Net margin is very, very close to basically break even. But, it's no accident that this is Barrick's chart, the 7 month chart, and just look at the performance. Gold is up over this time frame. Okay. And, wow. It's ugly. And look at it right now, just in the last 6 days, 6 days down in a row, just crumbling back to the October low. Okay, this is on the TSX. So in Canadian dollars, the support for Barrick is $19. That's a big, big level. So we will get earnings from Barrick on Wednesday morning, I believe. And then we'll get Kinross Wednesday afternoon. And then we'll get, Agnico on Thursday. And then the following week, we'll get more miners, including Kinross. Okay. So by the end of next week, not this coming week, but by the end of next week, we'll have a very good picture of the gold mining sector performance in Q4 of 2023. Remember that Q4 was a quarter of strong gold price performance. So that was when gold started the quarter around 1850 and ended it above 2000. And at one point it traded above 2100 during Q4. So the gold price performed well. Let's see how well the companies, the producers performed, and if they were able to hold costs down and actually generate a margin, an operating margin, and even a net margin. Okay. Yeah, we're going to talk more about Kinross and some of these charts in a bit, but let's start with this one. So there's a lot of parallels to late 2015 right now. Okay, I'm just going to name a few. The first one is this chart that the Huey, the gold bugs, okay, so this is this is a gold mining stock index that has been around for decades. And the ratio of the Huey to the price of gold is the lowest it has been since January 2016. You can see that Q4 2015 and January 2016 marked a major washout bottom in the gold mining sector. And there was this vertical ascent that took place in the GDX, the gold miners, over the next 6 to 7 months in 2016. A lot of people who backed up the truck and closed their eyes and bought that January 2016 bottom made a killing over the next 6 months in 2016. And that reversal, that sharp turn higher, is imprinted in a lot of people's minds, and they've been looking for it ever since then. It has never quite happened the same way. We had a little shot of that in 2020 for a few months, but that wasn't even as pronounced as that 2016 V bottom. It's actually even more than a V bottom. You can see how sharp that upside move was, right? So here we are, a fresh 8-year weekly closing low in the Huey gold ratio. Okay, so this is a sign that gold mining share prices are very depressed relative to the price of gold itself. And actually, you can pull up any number of ratio charts and analyze gold miner valuations. They are just atrocious. The performance has been nothing short of atrocious. It's horrid. So gold miners, relative to the NASDAQ or the financials or what have you, it's terrible, right? Just the performance is terrible, and gold miners are very cheap relative to historic averages, right? So, mean reversion is a theory, but markets tend to trend for many months and many years. And then at some point, they, revert a bit to the mean. but we really haven't seen that in the gold miners. We had what appears to have been that 2016 rally was a bear market rally in the gold sector, and there's no sign that we have a bear market bottom in the gold mining sector right here. Okay, the only thing we have to guide us is the fact that it's rarely been lower than it is today, right? Um, the GDX, so looking at this monthly chart of the GDX, it's forming, call it a pennant, call it a triangle. It's touched this trend line 3 or 4 times over the last 4 or 5 years. It's touched this trend line a few times over the last 2 years. So it's coiling up here, but this is a big coiling range. But notice the bottom, okay, the bottom rail here is coming in right around 26. So it's not far from testing this key trend support from the 2022 and 2023 lows. So let's see if that gets tested here in the next week or so. As soon as I see this chart and I see how hated the gold mining sector is today, I can't help but have a contrarian mindset that I want to try to look for a turn in the sector. But the reality is there's no evidence of a turn, okay? Even Franco, the big gold royalty company, okay, look, it's been absolutely obliterated in the last 6-7 months. Last week it was up. So, gold didn't trade well last week. Gold miners traded horribly. But Franco, the biggest gold royalty company, was up. So let's take a look. Let's add that to potential positive signs. I have noticed that in times past, Franco has often led the gold mining sector off of bottoms. It happened in March 2021. It happened in September 2022. Is it about to happen again? I don't know, but I noticed that we have a bullish candlestick last week against a backdrop of Barrick falling every single day last week. Now, the thing with Franco is that there's other things involved, okay, including Cobre Panama, which the market priced out of the stock, and maybe something's happening there. So it's not a perfect indicator of the gold sector by any means. But if we're looking for potential positive signs, the fact that this one was up last week is a potential positive sign. Okay. I also have to think that, investors are clearly bracing for a bad quarter from Barrick, right? So when they announce their quarterly results next week, the reaction to the report is going to be very important to watch, okay? Because we're heading into the earnings report oversold and bracing for bad news, right? So the bar is lower. The bar is not up here for Barrick. The bar is down here. Now, can they exceed a lower bar? That's going to be really important to watch, right? So I think anybody who's interested, an investor in the gold mining sector, is going to be really watching that Barrick report next week. And the fact that we're coming down to the October lows. If Barrick falls another 3% early in the week, it's going to be trading at the same levels it traded at in early October when gold was $200 lower. When gold was $200 an ounce lower. That's how bad this is. Kinross daily chart. Kinross performed fantastic from early October till the final week of 2023. Right? This is like a 50% gain. Almost 50% gain in a $5-6 billion market cap company. This was a great performance. So it displayed relative strength to the rest of the gold mining sector. It was holding up until last week. Last week, it got hit along with everyone else, including dropping 3% on Friday. But now, look where it's at. $5 is a big support level. You can look to the left in the chart. Clearly, there's big support around 510. The 200-day moving average is at 515. It closed last week at 516. So Kinross reports earnings Wednesday after the market closed. So heading into earnings, Kinross is at big support at its 200-day moving average, pretty beaten up in the last month. This is also going to be very interesting to watch. I'm going to talk a little bit about more about Barrick in a second. IAMGOLD. So this is, remember, whether we look at Barrick or Newmont or AEM, all pronounced downtrends. IAMGOLD, IAG. So I'm only focused on companies above $1 billion market cap. I'm not talking about the mid tiers or the juniors, in this video. I'm only talking about gold stocks that have more than a $1 billion market cap traded in the U.S. IAMGOLD is oscillating. It is just treading water, right? Higher lows, lower highs. It looks very much like the gold chart. So two companies that have my attention more than any other. I mean, obviously I'm focused on Barrick because it's a big one, but I have no interest really in trading Barrick. I have more interest in trading Kinross and IAMGOLD, IAG, especially next week. Okay. IAG is displaying relative strength in a very weak sector. KGC was displaying relative strength until a couple weeks ago. Now it's also gotten caught up in the selling, but they report this week. So what do they report, and how does the market respond? The key is the reaction. How does the market react to Kinross's report? But the fact that these stocks are so sold down, the bar is lowered significantly in terms of what the market is expecting. You have very key technical levels that you can use to guide you. Stop losses very close to where the stocks are trading at. This is setting up for a very interesting trading opportunity in a lot of these gold miner charts next week and the following week. Okay, I'm not going to give you an exact trade right now. If you want those, you got to subscribe to my trading lab or my Substack. But needless to say, there are some interesting setups forming as we move into next week and the next couple of weeks, with all the gold miners putting out their quarterly reports and holding conference calls and giving investors guidance for what they're seeing in 2024. This is going to be a really important time to be paying attention to what they're saying and to what this sector is doing. But the fact that the bar is substantially lowered as we come into this quarter, it actually gives an opportunity for some upside surprises and for investors to buy companies that actually meet their guidance. Okay, because everybody's expecting every company to miss their guidance, at this point. So, before we dig into Kinross, I want to talk about China, because China has been in a relentless accumulation of gold for the last couple of years, since mid 2022. And look at this chart, which is showing the Shanghai Gold Exchange. Actually, January of 2024 had its biggest inflows of gold ever. So what exactly is in there? I could show any number of China charts showing the PBOC, China gold buying, the Chinese consumers gold buying, but you get the picture. There is gold demand in China, and all signs are that it's not backing off. It may even be accelerating. Okay. So why is China so interested in accumulating gold, both the Chinese government and Chinese consumers? Why are they so voracious in their appetite for gold? Well, a lot of it has to do with the fact that China is experiencing the bursting of a massive, all capital letters, property bubble. Nobody knows exactly how big the fallout from this bursting of the property bubble is, but safe to say it's in the trillions of dollars. There are some people who even say that it could be in the tens of trillions of dollars. That's a very big number when you consider the size of the financial markets in China and even financial markets in the US. Trillions is actually some real money, especially tens of trillions. So, what happens in a debt bust when there's a huge amount of debt? The debts are bad, they're not being repaid, and a lot of institutions, a lot of banks are sitting with bad assets on their balance sheets, right? So they have compromised balance sheets and financial positions. Nobody trusts the accounting, the balance sheets, right? So you got deflation. You get a deflationary spiral because these banks are unable to lend at the same rates that they did in the past, right? So there's a contraction in lending, there's a contraction of consumer credit, and there's a contraction of economic activity, right? So if there's not, banks aren't making big loans to build new buildings, airports, roads, then those things don't happen, right? So it's up to the Chinese government to try to, reverse this debt deflation through fiscal stimulus. So the Chinese government is the only actor that's big enough and has the balance sheet to try to counteract this deflationary spiral that China finds itself in today. I mean, we've been worried about inflation for the last 3 years in the US and Europe. Well, that's not been the case in China. Yeah, they had this PPI spike in 2021 due to supply chain issues due to the pandemic. But since the pandemic pressures ease and the supply chains are back working again, this is outright deflation, right? So in the US, we have falling inflation. Inflation is getting lower, but it's still positive. It's still 3% or 3.4%, right? Well, China is in negative. So prices are falling across their economy, right? And that when you have deflation in an economy with high debt levels, you have a very big problem. You have a very big problem because you have economic activity also falling. And money is becoming more dear. It's becoming tighter. So if money is becoming tighter and more expensive, and there's lots of debt out there, a lot of that debt is not going to get repaid. It's not going to be serviced on time. And so we're seeing a bust, right? And I showed the copper chart earlier. We can look at the Shanghai Composite. I mean, basically, the first month of 2024, there's been a market panic in China and Shanghai. We got a rebound at the end of last week heading into the Chinese New Year, but it'll be really interesting to see what happens when Chinese markets reopen, because this looks to me like nothing more than a bear market rally, right? And there's all kinds of weird things happening in China where they're banning short selling. Government officials are telling hedge funds that they cannot deleverage their books, right? They can't sell. There's a lot of worrying signs, like all the stuff that you don't want to hear, like banning short selling on financial stocks, like happened in the U.S. in 2008, right? we know in hindsight that that was a very desperate move, and regulators were panicked and they didn't know what to do to stop the bloodshed in September, October 2008. So they were trying anything and everything until what really turned the tide at the end of 2008 and 2009? Well, it was the combination of fiscal stimulus and fiscal backstop, the US Treasury, the government backstopping debt, all kinds of debts, whether it was mortgage or corporate, TARP, all kinds of, they managed to bring together a lot of money guaranteed by the government, the balance sheet of the United States, the credit of the country to backstop lots of compromised balance sheets, compromised financial assets that were trading at low valuations. And then monetary policy stimulus. So it was the combination of monetary and fiscal stimulus, boom, boom, that stopped the bleeding. And then confidence started to pick up, stock market started to rally, the economy started to bottom, and zero interest rates plus QE infinity plus, and the crisis was averted finally, right? So China needs to do something similar to what the US did in the global financial crisis of 2008, 2009. So far, they have not gone to those extremes. The fiscal stimulus is not anywhere near what it needs to be to turn this around. And PBOC rate cuts are like drop in the ocean, right? Like they need to inject like trillions of won, trillions of the CNY currency, not billions, not tens of billions, not even hundreds of billions. This is going to take trillions. The T word. So when China starts talking Turkey trillions, then we'll know that it's serious and there's a chance that this is turning around. But until then, the size of the Chinese property market is just gargantuan. And we have no way, especially a foreigner, has no possible way of comprehending the extent of the bad debts there. There's no way of knowing. But there's a lot of bad debt. There's a lot of debt that's not being serviced, that's just going to need a lot of time to kick the can. So this is similar. There was a crisis in 2015. There was a China crisis in 2015. Think back to Q3, Q4, 2015. What was going on? We had an oil market just unwind, major bear market in crude oil. Right, so there was oversupply of crude oil. China's economy was in turmoil, and that was also weighing on the commodity markets. China was in a crisis in the second half of 2015. Right, and this is what we're experiencing today is just an extension of what was happening 10 years ago. It really is. They've been kicking the can and continuing to have malinvestment for the last decade. So and also what happened in end of 2015, the Fed was starting to talk about hiking rates and normalizing monetary policy. And it took a pivot from the Yellen Fed in early 2016 that actually really turned it around. So China started to backstop their markets and their economy and inject more, liquidity when they saw the Fed also acknowledge that inflation was undershooting and they weren't going to tighten, right? And that kind of gave China cover. I think we're in the same situation here. I think the Fed needs to signal that they're going to taper the QT and I think we're going to get a cut very soon. It may not be March, but it will be in May if it's not in March. and then China will really start to act. The Chinese government will start to um, unleash the fire hoses, for lack of a better way to describe it. And, really nobody knows how this is going to play out. Nobody knows how much stimulus it's going to take. So we're all just guessing here. But there's probably going to be a devaluation, because that's what happens. Like when you have a major bust of a bubble and lots of debts go bad, the currency needs to take the brunt of it, right? So the dollar versus CNY is like 7.2 right now. So it's 7.2 Chinese yuan to the US dollar. Maybe that needs to go to 9. Maybe it needs to go to 9.5. Maybe it needs to go to 10. I don't know. But I know that in the near term, that could be painful for markets, including metals. In the bigger picture, that is extremely bullish for gold, and that also explains partially why the Chinese central bank has stockpiled so much gold. They want to increase confidence in their currency, in their balance sheet, so they're scooping up as much gold as they can to backstop the mess they have on their hands, backstop the perceived value of their currency that's going to be taking some pain, right? And Chinese consumers aren't dumb. They want to have the timeless store of value with no counterparty risk instead of having money in one of their zombie banks, right? So it makes sense that the Chinese demand for gold in the last couple of years makes a lot of sense when you consider the mess that they have on their hands in China. And also Bitcoin. Like, why is Bitcoin at new 52-week highs, almost at 50,000 right now, when Fed funds rate is 5.5%? A lot of other cryptocurrencies aren't doing very well, still down 90% from their highs or more. Bitcoin is doing great. Well, because Bitcoin is digital gold. So Chinese would be, regardless of whether it's legal or not, they're finding a way to get Bitcoin, and they're finding a way to buy gold too. Gold and Bitcoin, probably the two safest, strongest assets you could possibly own today. When you consider how positive real interest rates are, right? We're still very positive, 1.7% positive on 10-year real rates. You would normally think that gold would not be at $2,038 an ounce with real rates this positive. And also you could make the same argument for Bitcoin, that Bitcoin does better in a negative real rate environment like we had in 2020 and 2021. And it would be weighed down by positive real interest rates. But think again, Bitcoin has broken out and gold has diverged from much of its real interest rate correlation. Now, obviously, on the margin, real rates definitely matter for gold. They definitely matter for everything. But the correlation has shifted in the last year or so. And a lot of that has to do with what's going on in China. And yields have moved up. I mean, look at how gold miners performed last week and look at what the 10-year note yield did. Okay, it's a pretty strong negative correlation there. We don't need to overthink this. Precious metals, commodities, mining stocks would prefer for interest rates, for treasury yields to be lower, to be falling, not showing signs of bottoming and turning back up again. Okay, so we definitely want to watch this 10-year note yield. A lot of people are calling for a rally in yields in the next month or two, that the Fed is going to put off the rate cuts. The economy is super strong. But you know what? This changes month to month. Okay, like everybody thinks that the economy is super strong right now. Come March, they could totally walk back that forecast. Okay, it's fluid. It's fluid. It's very fluid. Um, so and so let's talk Kinross. Okay, so we've talked about the bigger macro stuff. We've talked about China. We're not done yet, so we're not going to get to the Super Bowl picks. So yeah, we're going to talk about Kinross. So I those who have watched these videos frequently know that I like IAG, at least for a trade, as they ramp up production at Cote Lake. That's still on schedule for March, and we should get an update on that not this week but next week. Okay, so that's a catalyst for IAG that's coming up. But Kinross is very interesting to me, and it's a little bit easier to analyze this company than it is to analyze like a Barrick or a Newmont, much bigger uh, gold producers. So Kinross has been hit in 2024, like the rest of them, down 14.71%. And that's dropped its forward PE to about 12. Okay. And also, its price to book value is almost one. It's basically trading uh, almost at its book value. So, this is from a valuation standpoint, this is very interesting to me to be able to pick up a large gold producer at 12 times earnings at 1 times book is very attractive. So let's look at Kinross presentation and just sort of get an idea of what's going on here. So Tasiast, which is in Mauritania, this is their flagship mine, and it's actually a very good mine. It's a very profitable mine. Now, notice that they have been able to increase their earnings per share, while many other gold producers have not. That's the first thing. Also, notice the all in costs are pretty stable. So, yeah, I mean, 1,300 an ounce, it's not low, but it's not much worse than Newmont. In fact, I think it's better than, Newmont at this point, and it's stable. So, it's not like jumping drastically from 2022 to 2023. So let's see if they're able to continue this cost containment and continue to generate free cash flow. I mean, year to date, over $400 million of free cash flow. So I like the valuation, multiples. I like the trend in earnings, in all-in costs and free cash flow, and their production increased. And remember, this is the company that had some assets in Russia basically taken from them in a fire sale in 2022. I mean, some really good, some really good, some really good uh, gold assets they had to shed due to the sanctions, and they've weathered that storm. They've overcome that, and things are moving along. Okay. I mean, this all looks good to me. So Tasiast is a very attractive uh, gold mine. 610,000 ounces of gold equivalent production in 2023. So at 680 cost of sales. Okay. So this is a good operation. Let's see what the report is. Let's see if they continue to be on guidance there. And then another thing I'll note is their operations in the US, Fort Knox, Bald Mountain, Round Mountain, higher cost jurisdiction. Yes, cost of sales 1,300 an ounce, but better than some other companies. Okay. And what I really like is the Great Bear acquisition. So a lot of people sort of said the price they paid was way too high, almost 2 billion. It's true. It's a very high price for something that will not be in production probably for 8 to 10 years. But you're talking about a one of a kind asset, and the results that they've had since they've acquired it in early 2022. You know, look at the grades here. Yeah, it's deep, but you know, this is a very pregnant gold system at Great Bear. Very pregnant, and yeah, the resource as of now is like 4.5 million ounces, but this is going to be a lot bigger when it's all said and done, when they drill this thing out fully. So you have probably 10 million ounces of high grade. Um, you're talking about a 20 plus year mine life here. Very unique asset. Red Lake, best gold jurisdiction you could pretty much be in on planet Earth. 20 plus year mine life, 500,000 ounces a year of production, high grade, should be high margin, right? So it's one of a kind asset, and they're advancing it, right? Their surface construction plan for second half of 2024, PEA, so the maiden PEA will be second half of 2024. So you got a lot of major milestones. They are moving this project ahead, and this will be their flagship asset one day. And it's a hell of a flagship asset, right? This is the sort of flagship asset that Barrick or Newmont want, and Kinross has it right now. So, in my mind, as they further advance Great Bear, as they further de-risk it, and show some of the economics through a PEA, Kinross, becomes an acquisition target for Barrick or Newmont. Okay. And it's no secret that Barrick wanted Great Bear. They just weren't willing to pay what Kinross paid. So Kinross has my attention here. Kinross has my attention. And they will report earnings Wednesday afternoon. Has my attention. Both on a fundamental level valuation and a technical chart setup, coming down to support, testing the 200-day moving average. Pretty beaten up like the rest of the sector. Very interesting setup in Kinross. So I have no position in Kinross right now. The only one I have a position in is IAMGOLD of the stocks I discussed in this video. And that's it. Yeah. So, and just one final comment. I mean, this trend, the trend in margins of major gold producers is very similar to their share price trends. Okay, so it's not that complicated. It's not a big conspiracy. They faced a lot of macro headwinds the last few years, and just operationally, just performance wise, they've dropped the ball. So they need to pick it back up again. They're sort of, the whole sector is in the penalty box until they prove otherwise, and that's the simple way to put it. Just one sentence. The sector is in the penalty box, and they have to pull themselves out of it. And the only way to do that is to deliver results for investors. Okay. So the final topic, Super Bowl picks. So here are my picks. Three bets. Kansas City +3. So you have to buy the point. I think it's like -140 to get that point. So you bet 140 to win 100. You buy Kansas City to +3. That's number one. Number two, longest made field goal of the game, over 47 yards. There will be a 50-yarder kicked and made, right? So that's the second bet. That's a prop bet. And the third one, George Kittle, the 49ers, all-star, all-pro tight end, will catch a touchdown pass. So that's like, you should get odds on that. When you get Kansas City +3, you have to lay the 140. Well, with Kittle scoring a touchdown, you should get 140 or 150, you should be able to get paid more than you risk for that wager. So those are my 3 Super Bowl wagers. 1 on the game line and 2 prop bets. Sticking my neck out here in these videos. I mean, I could go 0 for 3 and look super stupid. Let's see what happens. Thanks for watching. Again, if you find value in these videos, hit the thumbs up button, like and subscribe at Goldfinger Capital on YouTube. Check out my Substack. Lots of good content there. And I hope you have a powerful trading week.